Hello everyone, welcome to today's video. We are in the final week of September 2023 and unfortunately the markets are not looking great at the moment, and I'm here to tell you that I think the markets are going to go down further, and I'll be giving you 3 reasons as to why I believe that's going to be the case. So the first main reason why I believe the markets are headed lower is because leading economic indicators are looking quite negative. Second, underlying breadth within the stock market indices has been looking quite weak. And lastly, historical data indicates that this is not a very good month for stocks in general. Now, without further ado, I'm going to dive into each of these points in more depth and then sort of flesh them out into more detail. So yeah, please click that like and subscribe button if you like what you are seeing. Alright, so the first thing I want to look at is the yield curve inversion. As you can see, this is basically the 10-year yield minus the 3-month yield. This is a historical chart. It goes back to the early 80s. And as you can see, the yield curve inversion has predicted pretty much every single recession. I think it's 8 out of 8 recessions. Not all of the 8 are shown in this graph. It goes back a bit further, but here I've just gone back to the 1980s because this website has limited data. As you can see, every time the yield curve has inverted, it's followed by a recession in the coming months. Not necessarily straight away, but in the coming months. And if you overlay that with the stock market, you'll begin to notice that the stock market doesn't necessarily crash when it inverts, but it actually starts going down as the inversion closes, as the inversion reverses. So it inverts here and then the inversion reverses a couple of months later, and this is quite often the point where we see the stock market begin to go down. So here's a chart of the SPY, which is the S&P 500 index, towards the end of 2000 going to 2001, and we can see that, I mean, the stock market started going down a little bit prior, but it just gets worse and worse. Now the same thing also happened during the yield curve inversion of 2007. Now you'll see the yield curve sort of begun to invert in July 2006. It did sort of try to invert before, but that was a very minor inversion. Now the proper inversion happened in July 2006, and then it closed, or the inversion reversed, in around May 2007. Now if you look at the SPY index, the SPY prices over that time period, the market didn't necessarily go down that much in July 2006. Well, it did a little bit, but as you can see, as it closed in May 2007, it continued to go up a little bit more, as you can see here, but then it promptly sort of started a pretty nasty correction here. As you can see, it fell more than 10%, which was enough to spook investors. And even in 2019, the market sort of crashed a few months after, as everyone remembers, but we can sort of ignore this inversion because it was mainly due to an exogenous factor, COVID. So let's just ignore that from our analysis for now. But this is the big elephant in the room, the current inversion, which is probably one of the deepest inversions in history, right? And if recent events are if recent prices are any indicator, it appears that this yield curve inversion is about to reverse as the long-dated, the 10-year yield continues to rise relative to the 3 months or the short-dated yield. And already we are beginning to see equities trend downwards over the past couple of weeks. But I think this is several months in the making. I think the markets have been lacking breadth, which we'll go into in a few minutes. Before we go any further, if you like the content in this video, please click that like button and then subscribe to my channel so that I know what you are interested in, and that would encourage me to produce more content of a similar nature. Now, another sort of leading economic indicator is that higher interest rates are now sort of being interpreted as being higher for longer, which is pretty negative for long-dated sort of growth stocks, which comprise quite a significant amount of the indices, especially the NASDAQ. So basically, higher interest rates for longer are bad for equities in the current state. Not bad for all equities, but for the growthier stocks. Another leading indicator is the money supply. As you can see, over the past, I don't know, well, throughout history, basically, the money supply has been increasing steadily. And then during COVID, it started rising exponentially. Obviously, that led to, that all contributed to the inflationary sort of mini crisis that we've been having over the past few years. And the Fed has has moved to quickly sort of reduce or taper its quantitative easing. So the money supply has actually been contracting for the first time in many decades in a meaningful fashion. This is a significant event, and as you can see, as it started to contract, the market sort of was forward-looking. It had already started declining way before July 22, and it actually recovered since November of last year. All the meanwhile, the money supply has been contracting. We do, however, see a slight increase in the money supply since the banking crisis in March and April of this year, but it's not really enough to say that money supply is increasing again. I think the overall trend here, as you can see, is quite is downward. Money supply is reducing, and that's going to be negative for equities because it basically reduces liquidity in the market. There's basically less capital flowing through the markets, so that's a negative for equities. Now, the second big reason has been the lack of participation, or the lack of underlying or weak underlying breadth in the market. Now, what do I mean by that? I mean, there hasn't really been a broad participation in this rally over the past couple of months. You know, the NASDAQ has gone up about, I don't know, what, 30-40% since its bottom in November last year. And only a few stocks have really contributed to that rally. As you can see here, the percentage of stocks above their 200-day moving average is still fairly low at about 37%, and it's been declining over the past couple of months. It never really got above, got nowhere near the prior high of around 90%. It sort of stalled at around 60, just around 60, and then it's been promptly crumbling, really. So basically what this chart is showing you is that the broader market has not really kept up with the rally in the indices, and it shows that the underlying market is quite weak. Now, I think that this could easily continue going lower. It could retest 30 and then possibly go beyond that. It could go even lower. Could go down to 20%, which would be quite bearish for equities, for the indices anyway. Now, just to further reiterate that point, I'll show you the equal weight index and how that is looking quite weak as well. This is the S&P 500 equal weight index ETF, and there was a bit of a spurt in the last couple of months, and that sort of topped out, and it's looking weak again, as you can see here, and it's on a downward trajectory. It sort of looks like it's bouncing around in sort of a bit of a trading range, and it really needs to find support. Otherwise, it's not going to be not going to be looking positive for equities, that's for sure. And furthermore, the Russell 2000 index, which is a small cap index, is also looking quite weak. So that's a negative for stocks. And the final reason that I want to talk about today is that historically, September has been a terrible month for equities. We're in the final week of September, so we're not quite done with this historically terrible month yet. So brace for further downside, I guess you could say. So this graphic from Yahoo Finance illustrates this beautifully. And as you can see, September historically has been a negative month for equities. Just if you had, basically this chart is showing you that if you had kept your money just in the month of September over the past like 65 years, you would have lost money, which is not the case for months like November, December, October. So history is not on our side, or the bull's side, when it comes to equity returns. On the bright side, I suppose there is the Santa Claus rally to look forward to after September. But even when we go to next next month, October, historically there have been some pretty nasty crashes in October. One of recent memory is, I think 2018 had a pretty rough October, and then of course 2008 was pretty rough as well. And I think in 87, Black Friday, I think that was Black Friday or Black Monday, were terrible for equities in 1987 as well, in October. So with that said, where are we headed in terms of stock market prices? I don't know where we're headed. I'm not going to tell you what to do because, look, I'm not a financial advisor. But I do believe that we're in for a fall of a minimum 15% from the recent top. So the Nasdaq sort of topped out last month at around 16,000. And I think it's going to go, go down to lower than 14,000. I think it might just go down just below 14,000. But hey, that's just my opinion. It could rally from here on out. Who knows? It could crash even further. So yeah, plan wisely. Hope, I'm having plenty of cash at the moment. I'm not really fully invested. I am hedging my portfolio by shorting Nasdaq futures, so that has helped the past couple of days. But yeah, I mean, look after yourselves out there, guys. Hopefully this presents a buying opportunity, if anything. So yeah, again, thanks for watching. If you liked this content, please click that like and subscribe button, and I'll see you in the next video.